All right, let's get straight to it. The market's giving us a major contradiction right now. You've got strong stocks, but weak headlines. Here's the framework I'm using for the next 1 to 2 weeks.
So let's just break this down. Look at the tape. The signals are all over the place, right? Stocks are strong, gold is strong, volatility. It spikes on a scary headline and then just collapses hours later. So what's the real signal here? Well, the key isn't the noise itself. It's how the market is reacting to that noise. That's the tell. Okay, here's the game plan for today. We're going to hit the top market movers, then dive into what's driving volatility. After that, key sector signals, the scenarios I'm watching, and finally some potential strategies. Straight to the point, no fluff. All right, first up, the top movers. Let's talk about the headlines. The market is absolutely climbing a wall of worry right now, and these are some very clear, very identifiable risks. So the bearish case is pretty easy to make. You've got the threat of a U.S. government shutdown, which could freeze economic data and really drag on growth. You've got the geopolitical stuff, constant tension in the Middle East, Eastern Europe, always a risk. Then layer on top of that the renewed trade friction with China, plus reports of their weakest growth in a year. This is the negative story weighing on the market. And let's be clear, any one of these could easily spark a sell-off. And that shutdown risk? It's not some far-off possibility. We're reportedly on day 20. Now that's the point where economists start getting nervous. They start talking about a real, measurable drag on quarterly GDP. So this isn't a future problem. It's a right-now problem. Okay, but here's where it gets interesting. How is the market actually processing all this fear? The real signal, the real tell, is in the VIX. And this chart right here shows you exactly what I'm talking about. You can see the VIX spiked up to that 23 level on those headlines. But look what happened next. It just couldn't hold. It collapsed right back down below 19, even hitting a low of 18.05. This is what I mean when I say fear is being rented, it's not being bought.
And this quote really nails it. It's been incredibly difficult to get VIX moves to stick once we get over 20. That level has basically become a line in the sand. Any spike above it gets hammered down by aggressive vol sellers. That tells you there's no real sustained panic under the surface.
And we're seeing confirmation of this in the options flow. Get this. A single trader came in and bought 10,000 VXX put options. Now, VXX tracks short-term vol. That is a huge bet that volatility was about to fall. And guess what? It paid off. This is a clear signal that sophisticated money is actively fading these fear spikes. Okay, let's drill down to the sector level. This is where we can see how this all plays out. The real opportunity is in this divergence. The gap between the macro fear and what's actually happening at the company level. So there are a few different stories playing out across sectors. You've got the semis like NVDA riding that long-term AI wave. BofA is even calling for a $1 trillion market there. Then in materials, you have a name like Cleveland-Cliffs making a strategic play on rare earths, basically positioning for that US-China friction. Biotech, as usual, is just a minefield of binary events, win or lose trial results. But here's the one I'm really watching, oil. WTI is trading near $57 a barrel. Now that is a huge deflationary signal. And what does that do? It gives the Fed plenty of room to stay supportive of this market. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. Okay, with that disclaimer out of the way, let's put all these conflicting pieces together. This brings us to the core idea for today, what I'm calling the volatility renters framework. It's how we can make sense of this divided market.
And this slide really lays it all out. On one side, you've got all the bearish headlines, the shutdown, the geopolitical stuff, weak China data. But on the other side, you have the market's actual reaction. The VIX gets crushed from its highs, dip buyers show up every single time, and you've got those big bets against volatility we just talked about. The bottom line is, the market hears the bad news, but it's actively choosing not to believe it'll derail the trend.
So here's the base case. The market is just a renter of fear. It prices in the headline risk for a little while, you get that VIX spike, and then it just reverts. The trade here isn't trying to predict the headlines. The trade is to fade the overreaction to those headlines. All right, so the bull thesis rests on a few key data points. The big catalyst is that deflationary pressure from oil, which lets the Fed stay on the sidelines. The flow is clear from those big options traders betting against vol, and the level to watch is the VIX failing to hold above 20. Now, how do we know this is wrong? A VIX close and hold above 22? That's the invalidation point. Now, the bear thesis. It's also very clear it gets triggered by a real shock, something like a major geopolitical event that actually hits energy supplies, or a shutdown that starts to seriously damage GDP forecasts. The signal here, the VIX would have to break and hold above that recent high of 23. That would tell us we're in a true risk-off regime shift.
Okay, so let's talk execution. How could a trader actually structure a position around this framework using defined risk options?
The process has to be disciplined. Number 1, you identify your catalyst. For example, a VIX spike over 20. Number 2, you assess implied volatility. Is it high? Is it likely to come back down? 3, you define your risk. Using spreads is the way to do this. And number 4, the most important step, set your invalidation level. You have to know exactly when the thesis is wrong.
So here are a few potential setups. If you want to fade that fear spike, a put-debit spread on VXX is one way to play the mean reversion in volatility. To hedge the portfolio against those macro risks, a protective put spread on the SPY could work. And if you're looking for equity upside, a bull call spread on the QQQ is a way to play that resilient risk appetite we've been seeing.
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.
So I'll leave you with the one central question that this whole framework raises. Is the market's resilience, this refusal to sell off on bad news, a sign of real underlying strength? Or is it just dangerous complacency, setting us up for a much sharper fall down the road? That's the risk you have to manage.